So we talked about international trade finance. We talked about the risks that we have to address in international trade. We talked about the documents involved, the parties involved, and how the trade actually takes place. We spent some time on letter of credit, the contract between the importer and exporter. And then we talked about how to finance the post-shipment financing, the pre-shipment financing, as well as how the Exim Bank plays into the international trade financing. So what I want to do today is to go over the quiz because this is a quiz for 2 weeks. And there are very specific questions that we went through. And I'm hoping that, after you complete it, or, while you're working on it, you could go through this video and it would actually give you ideas as to how to answer these questions. And remember, we always said that these quizzes are not to get you, but more part of your, learning experience. Meaning, there are some aspects of this discussion that I like you to focus and perhaps have more, information about it, and then these quizzes just make it so that you study a little bit more for these individual topics. So let's start with it. We have about 8 questions, and some of them are very simple but specific, and I'm hoping that we'll answer them as briefly as possible. So I started out by asking, what is a banker's acceptance and how is it useful in international trade finance? So remember we said that the process of a letter of credit or international trade starts with the pro forma invoice, and then we have some issues that we go through as to international regulation, logistics, the payment, um, insurance, the description of the product, so inspection, and all of that. We move on to the next stage of an actual order, an invoice, an agreement to buy and sell. Then we contact the importer and the exporter. We contract the importer and the exporter through a internationally accepted letter of credit. And at this stage, we choose an importer's bank and exporter's bank, and then we define the terms of the letter of credit as whether the payment is confirmed or not by a bank other than or by a bank chosen by the importer, accepted by the exporter, and obviously the term for the payment. Is it an at-site letter of credit or a deferred payment letter of credit? And then, obviously, once the letter of credit is opened, we have the exporter producing our goods, and then after they're produced, they will be delivered to the port, to the container, and then to the ship. Now, once it's actually delivered to the ship, there will be, and there can be, and a lot of the times there may be, an actual inspection of the goods in the container. You could have the insurance company, the customs authority, logistics company, importer's bank or the exporter's bank, definitely the inspection company for the product, and then all they actually go through individual steps of their responsibility as far as the letter of credit goes, and then they sign off on it. They say, okay, logistics wise, check. It's as specified in the LC. Customs clearance, check. Insurance, check. And then the actual inspection, check. And once everything is actually cleared and there are no reservations, as we discussed in the past week, an importer and exporter agree that the goods are as intended on board, free and clear, the importer's bank will sign off, and the exporter's bank will sign off, and the entire letter of credit will turn into an actual banker's acceptance. Now, a banker's acceptance is usually a 1 or 2 page document that simply says that the requirements of the letter of credit has been fulfilled, and all the parties have agreed to this fulfillment, and now a payment is due. If it is an at site, the payment is due immediately. If it is a deferred LC, then the payment clock starts ticking, and the payment will be due as specified by the deferred payment term. So the idea behind the banker's acceptance is it actually makes it so that the importer or the exporter can use this document because it actually shows that the letter of credit requirements have been fulfilled and there are no pending um, conditions to the payment. The payment will be due or is due, and through this, through the banker's acceptance, the importer or exporter can actually start looking for financing. So that's why it's useful. It is a conditional, well, it actually clears all the conditions on the letter of credit, and therefore it specifies that the payment is due, depending on whether it's a site or a deferred. So it makes it much easier for the importer or the exporter to seek financing for the product. If it is just a letter of credit, then there are so many things that can go wrong, and financing parties, the third parties, will usually not want to approach this to finance, as several things can actually go wrong. Okay, so why is it that international financing is a relatively safe investment for third-party investors? Now, obviously, the question with this one is, from a payment confirmation bank perspective, the payment confirmation bank is requesting a collateral for adding this confirmation. However, more importantly, this is a question as to whether the importer or the exporter are getting financed for pre-shipment or post-shipment financing. Especially in the post-shipment financing, the payment usually has, well, overwhelmingly, majority of the time, has a confirmation by a third confirming bank. And therefore, as the financing bank, or in the perspective of the financing bank, my risk is whether the payment confirmation bank will be making a payment or not, right? So, and remember, especially in the post-financing or post-shipment financing, the financing actually takes place after the shipment, which means we have a banker's acceptance, which means all the requirements of the LC have been fulfilled, and therefore there are no problems that can be raised as to the delivery of the product and the fulfillment of the LC. So no legal issues. And if anything goes wrong, you have insurance, you have the logistics company and whatnot. So the idea is that as a financing bank, then I can put a lien on the goods because they're on the ship and they're insured. And I also have a confirmation from a payment confirming bank. And therefore, I don't even care if the importer pays or not. I have the goods under my watch, and I have the payment confirmation bank's payment confirmation, and therefore I have a double collateral, and therefore for a post-shipment financing, that's why international financing is relatively safe. For pre-shipment financing, that's not exactly so, because in the pre-shipment financing, the guarantee is usually on the performance, and therefore you are actually getting an insurance by Exim Bank or some sort of a bid bond for the Exim Bank, and therefore there is not really a financing by a third bank, but from a Exim Bank perspective, they are providing a service for their region's exporters, and therefore for them, this is a big insurance pool, and if things fail, just as any other insurance company, they cover themselves through premiums. So the third question now is, what does Import-Export Bank of the US do? And I think this also applies to all Exim banks, but I want it to be a bit more specific as to perhaps the Exim Bank of the US can be in your search for a career. And then I would appreciate if you just go into Exim Bank's website and look if this is something that you want to pursue in your future academic or professional endeavors. So how does it finance international trade? And so, and I'm asking with respect to our lectures, because when you go to the Exim Bank's website, they provide so much information as, and sometimes it feels as if they're providing cash. But a lot of the times, the problem with a pre-shipment financing is that because there is no banker's acceptance, because the goods are not actually produced yet, so many things can actually go wrong. And because things can go wrong, and because there could be delays, there could be, you know, damages, less than acceptable conditions. There could be, customs or product-related disagreements. Um, I mean, like, we've talked about in our lectures how a shrimp farmer may not have the shrimp ready because of a hurricane, or some act of God, or a carpenter can produce a subpar product or undesired product or a product with a condition that's not acceptable by the importer. So these things make it so that we don't have an actual completed, cleared off, signed off product or delivery on time. So we don't have the goods are on the ship free and clear. We don't have that. So that's actually incredibly risky. And when the exporter needs a pre-shipment financing, um, for any third bank to provide this is not within their purview. And not just that they wouldn't be considering this, they just simply may not be able to. They may not have the expertise to judge the riskiness of the transaction. They may not be willing to take such risk. And therefore, most banks will not actually touch this. So what does the Exim Bank do? Well, the Exim Bank then provides either a conditional performance guarantee that the exporter will finish the products on time as desired, as agreed, or the Exim Bank will provide some sort of insurance that in case the exporter fails, the pre-shipment financing or the amount that we advance to the importer advance to the exporter may be returned. So that usually eliminates the risk of not having the goods ready and not having the banker's acceptance at hand, and therefore having the issues of related to this problems. So how does it finance international trade? Well, like I said, it appears as if Exim Bank is saying that they provide cash or money, but that's not usually the case. They provide guarantees that make it so that the advance payments or pre-shipment financing can happen. So it can be through providing insurance, it can be providing a performance guarantee or a conditional guarantee or a standby LC for the importer on behalf of the exporter. So that's how. And in the meantime, if you have any questions, please do ask. I mean, I'm available and happy to answer. So if you have money to invest, question number 4, if you have money to invest, how would I invest in, or if I have money to invest, how would I invest in international trade financing transactions? So this is, with respect to the financing of the operations. And I personally would not have the expertise to judge the riskiness of the exporter delivering the products on time, without damage, without conditional issues. I think the only way that I would actually be willing to do this would be through post-shipment financing. I would want it to have the banker's acceptance, in which case I would know the goods are on board free and clear and everybody signed off on it. Importer's bank signed off and exporter's bank signed off. And if it is a site LC, then the exporter is looking for some time to pay. And if it is a deferred LC, in which case the importer needs some time to pay, in which case I, as a third party, can provide financing to the importer or to the exporter, and in which case, uh, the idea is very simple. I pay whoever needs the financing, and they pay me at a future date. And when that happens, um, literally, I just charge interest. So why is it that I will be happy doing this? Especially when I provide a deferred payment or a deferred LC financing, uh, my issue would be that the payment confirmation bank is the bank who will be paying me in the future. And all I'm doing is I'm actually paying or making the payment to the importer now. So, once you have, let's say that we are actually importing from Germany, and in which case, um, a confirmation bank says that, or the payment confirmation says that they will pay us in 90 days. So let's say Deutsche Bank says, I will pay you in 90 days, but the importer needs to make the payment now. And so as a financing bank, I could make the payment now and then expect the Deutsche Bank to pay me in 90 days because it's a deferred payment LC. So in this example, my risk is whether Deutsche Bank would pay or not. So in that case, I think I will be very happy to finance this. And for such a short period of time, I could ask for an interest payment, or I could just pay it discounted. And I don't really have much of a payment or financing risk. Obviously, if I'm doing um, a, um, a site LC, in which case I have to make a payment now and then I have to collect from the importer at a later date, then I have to take collateral and to make sure that the importer will actually pay me in X amount of days. But even then, there are the goods that are being imported. I could put a lien on them. If the importer is local, I could actually take collaterals to make that payment. And so, the possible arrangements can be made so that the risk is minimal. And I don't even have to do this directly to the importer or to the exporter. I could potentially do this through a loan broker and or even international trade finance portfolios through investment banks or through commercial banks and finance such trade with rather um, rewarding interest rates while taking limited risk, especially as the example of Deutsche Bank paying in 90 days on a deferred LC, right? So as you can see, I'm giving you the answers, but now you still have to understand from it and then turn it into a few sentences and then, or a paragraph, and then the answer to these questions with your own words. And I think that's the, idea behind these quizzes, that I'd like you to study them, and I'm willing to study with you. I'm willing to explain it to you so that you would, learn these concepts. And when the time comes for you to work in this industry, you would know how things are done. So we have 4 more questions. Okay. So number 5, letter credit can be confirmed or unconfirmed. What is the subject of the confirmation? What is being confirmed? Why is there a need for confirmation, and who confirms it? So this is a rather easy question. And we answered this in our lectures, and the letter credit is confirmed for payment. And a third bank will add a payment confirmation on behalf of the importer. Now, this bank can actually be importer's bank. So if I have the LC open through Chase, I already have a relationship with them, and the Chase could be actually adding their payment confirmation to this LC for me while taking proper collateralization from me. However, I might find it that the fees or the commissions or the interest charged by Chase may be too much. So I may be asking for other banks or other financing entities to provide me with that financing or payment confirmation, and they will be a third bank. The condition now is, though, that the exporter has to agree to this. Meaning, now that I actually have a payment confirmation, the idea is that, or why is there a need for confirmation? Because the exporter does not trust the importer. What if the exporter delivers the goods, but the importer does not pay? right? So that's why the exporter is requiring a payment confirmation by a bank. Now, if I'm going to be using a bank that's not already accepted by exporter, they may not agree to this. You know, ABC Bank out of, I don't know, some unheard of city, you know, a tiny bitty company, or out of an offshore island, and the exporter simply may not be okay with this. So, and remember, the exporter has to agree that the payment confirmation is okay. So, a third party can add this payment confirmation on behalf of the importer, and but the condition again is that the exporter has to agree to the credibility the of the payment confirmation bank. So, question number 6: in a letter of credit, the exporter allows the importer to pay 3 months after the goods are on the ship, free and clear, which means this is a deferred payment letter of credit. So obviously that's your answer for the question. But the real question is, how is it useful? So from a perspective of a exporter, why would the exporter allow 3 months of a payment when obviously anybody would prefer to pay at site immediately? So it could be that it is a buyer's market, or this product is specific and it requires the importer to have some time. Like, for instance, let's say we are exporting cars. We basically are assuming that it will take about a month for the cars to ship, and then the importer will put them on the lot, and then he will need time to sell these cars, and then we'll turn around and pay the exporter. So in which case the exporter may allow the importer for this shipping time and to the sale time, and it might actually make the transaction happen. So in some cases, the importer simply may not have the money. I mean, they may be a retail facility, it may be a sales facility, maybe a construction deal, it may be a farming deal where the importer simply may not have the means to pay um, for the goods unless he sells the goods himself. So in this case, the exporter may allow X number of days, so in this example, 3 months, for the importer to pay. It is referred to as a deferred payment LC, and it is useful because it allows for the importer to be able to um, get the goods on consignment as a, not a legal term consignment, but with a time to pay. Because remember, the LC is irrevocable and the payment is guaranteed. So the consignment usually refers as, if he cannot sell, he will return. There is no such thing. He bought the goods. It's just that this is a flexibility in payment in which the exporter allows the importer to pay at a later date after the goods are delivered on board free and clear. So, right, so then we actually go to question number 7. So on question number 7, in a letter of credit, the exporter requires immediate payment. Right, so we have the exporter requiring immediate payment. So when the exporter requires immediate payment, that is a at-site LC, and the importer needs 3 months to pay. Right, so this is a very specifically a post-shipment financing. So the way it works is that when we have the goods that are on board free and clear, we have the banker's acceptance, which simply means that we actually have individual parties to the letter of credit agree that all the requirements of the letter of credit have been fulfilled, and the importer's bank and the exporter's bank all agree that the requirements have been fulfilled, and they sign off, and now we have a banker's acceptance that everything is free and clear and payment needs to be made. And since this is at site LC, which the exporter requires immediate payment, the payment confirmation bank will actually make that payment as soon as goods are on board, free and clear. And then the payment confirmation bank will be returning to the or turning to the importer for him to make a payment, and at that point the importer needs to pay. But remember, the question is the importer needs 3 months to pay, which means that within that immediate request for a payment, the importer simply does not have the money and he needs a payment. So he can have the importer's bank, his own bank, to provide him financing, but that payment needs to be done that day because it's a site LC. And because it's a post-shipment, this is actually happening after the shipment, and the site applies here. So you will then, with the banker's acceptance, you will start looking for financing banks. And they can be anywhere in the world. It could be individuals, brokerage companies, loan brokerage companies. It could be banks. It could be related banks, unrelated banks. Simply, he will be sending his banker's acceptance and asking for a payment. So the idea now is, though, what makes this a bit complicated is because the importer needs the payment to be made immediately. Or the LC needs to be paid immediately. So the importer says, please make the payment for me today, and I will pay you in 3 months. So while the importer will be looking for financing banks around the world, the problem is that this is not where there is a payment guarantee for another bank. This is literally a site payment that he needs to make today, and then he promises to pay in 3 months. So his chances of getting this financing from a local bank is a lot higher, simply because he needs to provide collateral and a payment promise, a promissory note, that he will actually fulfill his payment duty in 3 months. So while, like I said, depending on his reputation, if this is a corporation, if this can be financed by a foreign bank, which it can be, but the idea is always whether he can actually get that guarantee from a unrelated bank. So his chances of getting this financing from a local bank is a lot higher, simply because he can provide collateral that if he doesn't pay in 3 months, those collaterals can be liquidated and payment can be redeemed. So this is the site LC, and importer needs a post-shipment financing, and this is actually how it works. So like I said, if you have any questions, let me know. And our final question is, in a letter of credit, the exporter needs advance payment for production, pre-shipment. However, the importer wants to pay after the goods are delivered. Like I said, pre-shipment, but the importer simply does not want to make that advance payment, so we are at a deadlock. So this is a pre-shipment financing, and we need to have an Exim Bank involved. And the reason for this is commercial banks will not have the expertise to judge how risky this transaction is, because they are asked to provide a conditional performance guarantee on behalf of the exporter, so that the exporter can receive this payment before the production is made, before the delivery is made, before all the parties to the LC signs off on this. And therefore, this is a complicated case for commercial banks. And most of the commercial banks will simply not want to go financing this. Again, it's just too risky. So for them, because this is too risky, and the exporter probably will not be willing to pay the excessive amount of fees or the commissions or the interest because of the risk involved, the Exim Bank usually is the party who would provide the performance guarantee or an insurance in case the exporter fails to deliver on time or with the condition expected, and there are issues with the LC. And the way that it works is, at this point, exporter or the importer will apply for Exim Bank help, but more than likely the exporter will apply for the Exim Bank help, and the Exim Bank will provide for a small fee or a commission, an actual insurance that the payment will be made. I'm sorry, that the products will be produced and delivered, and if it's not being delivered, then the payment will be returned to the importer, or the prepayment will be returned to the importer. Now, again, this is the definition of a pre-shipment financing, and it also can be defined as pre-shipment insurance, or I'm sure different Exim banks may have different names or titles for it. So it's we used to refer to it as exporter financing, but the exporter can also be financed afterwards for a site LC. So it also can be a post-shipment financing. So I guess the proper terminology should be that this is a pre-shipment exporter financing, and it can actually work through a performance guarantee or a payment insurance for the importer in case the letter of credit is not requirement of the letter of credit is not fulfilled. So that's about it. So thank you so much. It's been 2 weeks that we actually went through this topic, and I really do hope that this was an enjoyable subject, and we'll continue with our lectures. And if you have any questions, please let me know. I really do appreciate you working with me, and I hope to see you soon. And again, please let me know if you have any questions. Thank you so much, and take care. Bye now.